Good morning and welcome to another video cast from Hendy Consulting, the specialist management consulting firm to the $125 billion display industry. And today what we're going to talk about is capital planning. So by that I mean CapEx planning, mostly in factories for the display world. But we are going to also talk about the issues involved in joint ventures and partnering in the display industry. So we've really got three themes to talk about here. The first one are what are the economic drivers of display fab investments, so be that LCD OLED or novel technology. What are the issues that you need to think through as a general or executive manager when signing off a large investment in a display fab? Secondly, we are going to talk about what happens if somebody's considering the same sort of investment but further back in the supply chain. So say you're a supplier to the display industry, but you still have to decide how much floor space for tool assembly you're going to have, or how many wafer starts you need to start, or something like that further back in the chain. How do you think about your capital planning processes? And then finally, just because serendipity of our work over the last 20 years in the display space, we've actually been involved quite a few times in partnering or JV exercises related to putting together two display companies. We're going to talk about that also. And we have actually published 3 articles in Information Display on M&A in the display industry, the key economic drivers, rationales, case studies, and the like. And so if you're further interested in that topic, I refer you to those. So first, it's worth saying that the main drivers of value creation are actually slightly different, and the key topics are slightly different depending on these 3 areas I would focus most of your attention on. If you're talking about an LCD OLED or display related fab in general, then one of the key starting points is product mix and product positioning in general. So what is the actual offer? How does it compete with other technologies around it? And what is the mix on the fab? That coupled with a pretty tight view on material cost and material cost development. I think people overly focus typically on the CapEx number, whereas it's the OpEx number in relation to pricing that kills you. And Asian players focus much more heavily on the OpEx numbers. Getting the positioning of the fab correct in terms of competing technologies also becomes fairly important. If you're moving back in the supply chain, so let's say you're making an investment as one of the tool suppliers, material suppliers, or the like to the industry, then again, one of the things I would be very aware of then is the market demand picture, both in terms of competing technologies, market timing. But let's say we're talking about microLED, then you're also concerned with die size and average die size changes. Let's say if you're a wafer producer or further back from that, those become critical variables. The whole pricing environment in the crystal cycle is also important so that you understand the economic rationales of your display customers. When it comes down to JV or merger planning, that's something through serendipity we've been involved in quite a few times over our working career. And actually, you're discussing the synergy value creation. And all I can say is that the most successful pots, as far as I'm concerned, come from product technology and mix related questions. Certainly, there's one case study on the Foxconn and Sharp case where they really did lay out quite an impressive merger integration plan. I feel that they've not executed on that adequately enough, and they've managed Sharp at arm's length. But there was always the good rationale in terms of how this could have created value. Operational parameters also then being important. So if you happen to be the strong player picking up a weaker piece off the chessboard, then actually sometimes you can create, ironically, the greatest value by finding a weaker player. But it's the product technology axes in JV planning that I want to accentuate. So what then actually makes CapEx planning in the display industry so huge? Well, I think it's partially because the numbers themselves can be very large. So if you're talking about some of the Flex OLED fabs or large LCD fabs, you are talking in the single-digit billions. And it's that which really swings people's heads. And that's in an environment that has quite a lot of forward-looking risk and ambiguity, and certainly a changing and cyclical pricing environment also. The fact that there's many technical competitors often against a space also means that some external advice from an expert could be really helpful when you think through these issues. So let's talk about a fab investment here shown schematically as a sort of cash flow picture, with the red bar downwards being the major capital investment and then the green bars being the free cash flows generating. Nearly always there's a preparation period in terms of technology readiness, the materials, the equipment, and so forth, and often a pilot test line facility that comes before people consider the major investment. And then actually, when considering the capex, there are decisions like new or second-hand equipment and the industrial strategy in general. And often there are a range of choices in industrial strategy about exactly how to do things. Sometimes you can partner with the display industry to use some of their finished goods for part of it and then build a smaller fab separately. But all of those questions are coupled with control points and investments become important in determining the free cash flow profile. Then thereafter, basically you want to ramp a fab into a positive price environment so that it creates its peak cash flows in the years 3 to 5 pretty much. As yield runs to peak, then that's when you want to be making your money, and you do at least want to be making a discounted positive return by at least at year 9, even though these factories can actually live for up to 22 years, and there's quite some discussions you can have on perpetual terminal values or other things to think about what is a fair representation of a factory. But suffice to say then that actually having done this before and looked at a number of different investments, there are some really useful key heuristics to look at in terms of peak sales over capex, gross margin and EBIT evolution and other things that can give you a sense that this actually might be a sensible plan or not. So then let's talk a little bit more about joint venture planning in terms of putting together two display companies. And we've been involved in things like this 2 or 3 times in our working history. And it's actually what's actually really interesting out of this is that the product technology mix axis is probably, to me, one of the most important ones in terms of creating new value. Yes, there could be something in terms of product cost savings, some optimization of dedicated facilities, and then certainly some headcount related cost reductions possible. But overall, basically, I think the product technology axis is the most important when considering venturing between two major companies. And yet, in some cases also, there could be, like in the case with BOE and CEC Panda, the operational variables and load may be something that is the primary lever for value creation in that case. And all we'd argue to you is that actually making a solid decision here is based on a number of tools. Firstly, we would always advocate a solid discount cash flow model, but probably under a range of scenarios. And then through that, thinking about a range of different business decisions and different scopes that you could use, potentially putting in place capacity in stages and thinking about that as a way of mitigating demand. But also we would always say, think about what are the alternative business choices you could make, either joint ventures or sole investments or other things that could be viable business alternatives to the thing that you're thinking about. Because I think it's this choices between different investment options with different risks that really raises the game and means that you can make the optimal decision. So when we're talking about LCD, OLED, novel display factory investment cases, then really the place to start is product and product mix and product cost. And getting all of those things right, the easiest way to swing an MPV on a fab investment is to swing the mix to premium mix, and it's the easiest way to move the numbers. But then you have to be very realistic about what portion of the total mix might be premium. Your cost position and supply base is then important because it's OPEX that will kill you in the long term more than the CAPEX will. And understanding the price environment and where that's likely to move and your actual fab timing against that is probably fairly useful. We would say also that the industrial strategy itself and exactly what to build is somewhat useful. And then subsidies are nice, but further down the list. If you don't get the material cost right against the pricing environment, then it didn't matter how much the CAPEX costed. And in JV cases, it's really about the total synergy value creation, and all we would argue here is, yes, sometimes operational parameters like yield and load can be important ones, but if you're putting together two reasonable firms, then it's the technology and product axis, product portfolio overall, mix, and technology sharing that actually can often create the greatest amount of value. There might be something to do with rededicating products on specific factories, which is where I call industrial strategy here, and also then thinking it through in terms of against the market timing backdrop also matters. We would tend to say that overall the headcount related areas are less important. So we have in the LGD times, when both David and I were involved in several rounds of capital approval, we got used to seeing the thinking about the risks involved in these large fabs. So that's something we've definitely done multiple rounds of. Since then, as Hendy Consulting, we have been involved in quite a few cases of large investments, certainly here more than $1 billion, of people putting down different types of facilities against capital planning exercises. And more than that, the thing that we do actually very regularly is to work for novel technology startups doing fab planning. And that's really often in combination with a display technology partner or alone, trying to talk about what the NPV of a novel display technology would look like. It actually is often very useful when you start thinking about product cost over a multi-year period, and that against also a declining price horizon, that you start really sharpening your pencils on thinking about how the novel technology is going to compete. So I would argue that these sort of factory costing NPV exercises are a very useful part of establishing a value proposition of a novel technology. So fine, that was our 10 minutes today on CapEx planning for the display industry. I hope you get a sense that actually, because the numbers are large and because the risks are high, that scenario-based discount cash flow analysis with somebody who can relate that strongly to the actual behaviours in the display industry at the time is a very valuable thing to do for an executive team to do, to understand whether they should be investing 100 million or €1 billion at any point in time into some sort of facility. It's the increased insight on the controllable and uncontrollable drivers and just the range of choices that you have always in making an investment plan that actually raises the level of the conversation and reduces the risk. So I hope you found that interesting.